Welcome to The Explainer. Right now, as we speak, a $3 trillion shadow banking crisis is unfolding just completely out of public sight. For over a decade, capital has quietly poured into this unregulated, highly opaque lending machine. But today, well, the gears of that machine are really starting to grind to a halt. So, we're going to conduct a real-time autopsy of the private credit market to show you exactly how this massive system was built, why it's currently fracturing, and ultimately where the blast radius is going to hit. Let's dive right in with a number, 9.2%. And look, this isn't some far-off projection. This is reality right now. In late 2025, Fitch Ratings flagged that the private credit default rate had suddenly surged to a record 9.2%. Now, for a market that has routinely claimed its default rates were hovering around a really pristine 2%, this neon red warning sign tells us that the narrative has abruptly shifted from a slow burn to an acute fire. Which brings us to the really big central question of this whole explainer. Is this the financial crisis that happens in slow motion, just gradually draining the economy? Or is it the one that suddenly isn't? A cascading failure that catches the entire global financial system completely off guard. To answer that, we really have to look under the hood. Here is our roadmap for today. We'll be covering 1. The warning sign. 2. Inside private credit. 3. The AI borrower collapse. 4. The liquidity trap. 5. Echoes of 2008. And finally, 6. Who gets hurt? All right, part 1, the warning sign, or what we can call the catalyst. Because look, this crisis, it isn't theoretical anymore. The catalyst has already arrived. Let's look at exactly what happened in early 2026. Major funds managed by absolute giants in the space, we're talking Blue Owl Capital, Blackstone, Morgan Stanley, they were suddenly hit with a massive wave of withdrawal requests from investors looking to cash out. But there was a problem. They couldn't pay everyone. They had to enforce gates, essentially completely freezing withdrawals. Practically overnight, over $150 billion in retail capital was trapped. And historically, when investors cannot access their own money, a market stops functioning on trust and immediately starts running on panic. Moving on to Section 2, Inside Private Credit, the anatomy. To understand why those funds just froze up, we kind of have to look at the plumbing of the machine itself. So what exactly is private credit? Often called shadow banking, these are simply direct loans made by investment funds directly to businesses. They just cut out the traditional banks entirely. After the 2008 financial crisis, really heavy regulations forced traditional banks to step back from risky corporate lending. So private credit funds eagerly rushed right into that vacuum, operating largely outside of any real regulatory oversight. And the sheer scale of the resulting boom is it's staggering, honestly. Back in 2010, this was a relatively niche, $200 billion market. But by 2020, fueled by this era of zero interest rates, yield-starved investors pumped it up to $2 trillion. And by 2025, it hit a massive $3 trillion. It literally became a central artery of global finance. But there is a massive problem here, and that is opacity. Market participants and regulators can't even agree on a unified definition or the exact size of the private credit market. The estimates vary wildly depending on what you actually include in the bucket. Unlike public bonds, there's no continuous market pricing. It is a dark pool. And let me tell you, when you have $3 trillion just sitting in the dark, risks tend to mutate completely unseen. Which brings us to Section 3, the AI borrower collapse, the disease. Every financial crisis needs a disease, right? A fatal flaw in the underlying assets. Here, a massive chunk of private credit, nearly 40% of some portfolios, was lent to mid-market software companies. During the boom, these were beloved. They were asset-light, fast-growing firms. But then came the SaaS apocalypse. Generative AI is rapidly eroding the competitive moats of these very software companies. Today, roughly 40% of private credit borrowers actually have negative free cash flow. That means they aren't even making enough money to cover their own expenses, let alone pay back their debt in a high-interest rate world. So, you might be wondering, how do these companies even survive if they don't have the cash? Well, they use an accounting trick called PIK, or payment in kind. This is a non-cash mechanism where distressed borrowers pay their interest by simply issuing even more debt to the lender. So the fund gets to pretend the loan is performing perfectly at full value while the borrower survives for just another quarter. It effectively masks the fact that many of these software firms are functional zombies, completely hiding the true extent of the corporate distress going on. All right, Section 4, the liquidity trap. Let's get into the mechanics. Let's see how a slump in the software sector actually morphs into a full-blown structural financial lockdown. We have a massive structural mismatch here. On one side, we have liquid promises. To attract everyday retail investors, these funds heavily marketed easy liquidity, often promising you could just withdraw 5% of your money every single quarter. But on the other side, illiquid reality. The funds took that easily withdrawable cash and locked it away into multi-year, highly illiquid corporate loans. Capital flows in without friction, sure, but when everyone wants out at the exact same time, the math simply breaks down. And here is exactly how that contagion actually spreads, step by step. Step 1, initial portfolio stress. Those AI-disrupted software companies we talked about, they start defaulting. Step 2, bank credit pressure. The funds, bleeding cash from investor withdrawals, end up maxing out their credit lines with traditional banks. Step 3, forced asset sales. To survive, these funds have to fire sale their loans at massive, massive discounts, completely destroying the illusion of their high valuations. And Step 4, contagion spread. Panic ripples through the entire market, forcing more redemptions, more fire sales, and suddenly the banks themselves are heavily exposed. Section 5, Echoes of 2008, the prognosis. Now, if this structural setup is giving you a massive sense of déjà vu, trust me, you are not alone. Yes, the assets are different. We're talking corporate software loans instead of suburban mortgages. But the recipe for disaster, it is absolutely identical. We have the exact same 3 shared ingredients. Opacity in pricing, where nobody truly knows what the assets are worth until it's way too late. Extreme leverage, hidden deep within those corporate borrowers. And a severe liquidity mismatch, essentially using short-term investor cash to fund long-term, illiquid bets. And the thing is, the dominoes are already falling. Point 1. Late 2024, we saw the subprime auto lender Tricolor completely collapse. Point 2. 2025 brought multi-billion-dollar fraud allegations at First Brands, and we saw the first major retail fund freezes. And now, point 3, the terrifying 2026 maturity wall. Right now, $875 billion in commercial real estate loans are coming due. These properties are underwater, banks won't refinance them, and the private credit lenders holding the bag are simultaneously facing their very own cash crunch. Finally, Section 6, who gets hurt? Let's look at the blast radius. When this whole thing finally hits bottom, we really need to know whose money is actually on the line here. Back in 2008, traditional banks took the direct hit. But today, the exposure has been pushed way out into the broader economy. The largest participants funding this market represent pension funds, insurance companies, and everyday retail savers. So the real bag holders of this shadow banking system are actually ordinary retirement accounts that were promised safe, stable yields during an era of incredibly low interest rates. Which leaves us staring down 2 very different paths for the future of the global economy. Path 1 is a managed slowdown. Here, we avoid a spectacular overnight crash, but we face years of constrained lending, capital stays trapped in those zombie firms we talked about, slowly dragging down economic growth. It's essentially a long, bitter economic winter. Path 2, though, is a cascading crisis. This is where funds drain their bank credit lines, forced fire sales collapse global valuations entirely, and the panic bleeds directly into the regulated banking system. I want to leave you with this final, kind of provocative thought. As the cracks in this $3 trillion system continue to widen, it really forces all of us to rethink risk. For the average retail participant, it is a sobering reminder that there is no such thing as a safe 10% yield. Because when capital moves into the shadows just to escape regulation, the risk doesn't magically disappear. It just waits in the dark. Thank you so much for joining me for this explainer. Make sure you keep your eyes on the data, and as always, stay curious.